Hi, my name is Scott Gibson with Beneath the Surface. I'm here with Jim Letourneau of the Big Picture Speculator. Thanks for being with us. Jim, thanks for being with us.
Always a pleasure.
Now, wanted to get your take on 2013 going forward here. Now that we're at the beginning of the year, what do you think is going to come for both the metals and the economy?
I'm really optimistic about the economy. A really good indicator of economic health, at least in North America, is how FedEx. FedEx is making new highs, multi-year highs, just breaking out, and that's a really good indicator. FedEx is doing well, people are buying things are getting shipped. In Canada, WestJet's got record load factors, the railways are doing well. All of these things are pretty good indicators that economic growth is doing really well.
And what does that translate for you in terms of the metals, gold, silver, base metals?
There's going to be more demand for metals, especially if there's any industrial use, because a strong economy is good for metal demand. So we're in a pretty good spot. It doesn't seem like it, but the Shanghai index is starting to move up. There's all kinds of signs that we're back into a growth model. And that's very good for metal prices.
And what does that mean for stocks? We're sitting here in 2013 coming off of almost 2-year pullback in junior mining stocks.
The challenge for the mining stocks is that we're really now in a world where we have global financial markets. Commodities are just a sector for big hedge funds to offload risk, to have a non-correlated asset to the financial markets. And going from $20 billion in ETFs a decade ago to over $200 billion now means that commodity prices are actually more and more correlated to financial markets and the price of oil than they've ever been. So it's hard to find something that doesn't track all the other things in the market. The only exception might be natural gas, which went low, but it's hard for supply and demand doesn't matter as much for commodity pricing because you have this financial overhang of really big money that's trying to use it to offload risk. So it's an interesting time. Ultimately, supply and demand always matters, but it can take a long time before it kicks in. But I think we're heading to that time.
And what's your take then sort of for this year in terms of the gold price, that it sort of stays flat, inches up, range bound?
I would say range bound unless there's a surprise. So gold is often used as, it's a great thing to have as insurance because if whatever that surprise is, and I don't know what the surprise will be, but there's always a surprise. If it's a negative type surprise, it's probably going to help support gold. Then the other thing that will support it is just a thriving economy. A lot of the emerging market countries like to buy gold. It's a form of wealth. So we get a lot of demand. Consumer demand can help as well. So buying more from a position of prosperity rather than a position of fear, which is always a happier story.
Yeah, exactly. And what are the type of companies you like now in terms of gold?
Given all of the risk and the things that have happened with the juniors, they're a little cash poor, cash starved. They might get cheaper. But there's two types of companies, the streaming type companies where they're actually getting revenue off of production, or something like Silver Wheaton, right? Companies like that, or Sandstorm. Energy and Metals and Sandstorm Gold both have that model where there's some money crossing the table. And the other one is a prospect generator, where they farm out all of their, they don't have to put up much of their own capital. So those types of companies, you got some diversified exposure in case things really take off, and your downside is much more limited.
Mm-hmm. And in terms of ownership of those companies, I don't own Silver Wheaton, I do own Sandstorm, don't own Sandstorm Base Metals. How about yourself?
I don't own either at the moment.
And the joint venture companies, is there a particular one that you like, or ones that you like out there?
There's a few out there. Probably one of the longest running one is Altius, but there are several, and they're pretty easy to find. And I like those as well. Yeah,
I own a number of them. I don't actually own Altius, but it's a great model.
Yeah.
Can you explain to our audience a little bit more about the JV model and how it works and why it's attractive at this stage of the market?
What's attractive is the lead company will put together prospects that look interesting. They usually got a pretty good team of geologists, but they don't use their own money to explore it. So they can vend it out to other companies, maintain an interest or a royalty, but usually they've got a pretty big chunk of it. So that the company that takes that property on and chooses to develop it further, they have exposure to the upside, but they don't have to outlay any money. So their share structures, and sometimes they even make a little money because they'll get a management fee to manage the exploration efforts. So they basically don't spend a lot of money. Their share structures typically stay intact. They don't have to sell shares to raise money because they get the money when they joint venture their properties out. So it's pretty compelling. Plus, it's diversified. It's not a one-shot deal. You know, you have exposure to upside and less exposure. You don't have the cash burn all the time, which is the killing thing for a lot of junior companies.
It is. And what's attractive about them now is a lot of them are trading at or near their lows.
Exactly. So there's, the risk is the partners don't follow through on their exploration commitments, but they get their property back. So it's not that bad.
Yeah. And what about on the royalty side? Can you explain that a little bit further of how they work and why you find that attractive now?
Well, the first thing about a royalty means, if a project's in production, you're getting paid. And we don't see a lot of that in the junior mining sector. I mean, most of these companies aren't in production. So money crossing the table is always good. And at a royalty, you don't have to worry about how much it costs. The cost of production is irrelevant to your royalty coming in. You've got that money coming in on a regular basis. That's huge. That's a really good model.
Yeah. Well, another situation like you're describing where that's limited downside risk for our space with still the upside of gold price appreciation or exploration, increased production.
Exactly. So you want diversified exposure to upside surprises and obviously less exposure to the downside, which has been a real problem in the last couple of years.
Exactly. Thanks very much, Jim.
Thank you.
Again, that's Jim Letourneau, Big Picture Speculator. My name is Scott Gibson with Beneath the Surface. Thanks for being with us.